In our last voiceover for Chapter 9, we just have a few remaining topics. One of those is impairment, and the other one is what to do at the end when we get rid of the assets. We had planned on removing the assets because we said that the assets only had a certain useful life, so we know we're going to be rid of them, and what do we do then? What's the accounting for that? But the first topic, which is a very kind of a sad topic for companies, is impairment. And impairment is when an asset declines in value. And by a decline in value, we're not talking about a book value, we're talking about a decline in, say, market value or its resale value. And this is a problem for a company because it means that the company is going to have to mark down the value of their assets on their financial statements. Early on in this semester we said assets were things of value. They are good things for a company. Liabilities, on the other hand, were bad things. So we really want to maximize our assets, and that makes our balance sheet look good. So having to reduce the value of an asset is not something that we really like doing. However, according to GAAP, when the estimated future cash flows from one of these long-lived assets fall below the book value, then we have to recognize a loss. So not only is it bad for the balance sheet, it's going to be bad for the income statement because we're going to show a loss, which is going to reduce net income. So what can happen? A casualty, obsolescence, a lack of demand for the asset services, all sorts of things can happen to reduce the value of this asset. Bear in mind that we have been taking depreciation, so this is beyond depreciation, a decline in value. So companies will try to avoid having to report impairment because impairment can mean then that their production facilities are growing old or obsolete, which means they're going to have to come up with cash and financing to replace them. It means that their output is going to be reduced in the future, and it's just generally a very negative signal that goes to the stock market, and it will negatively impact stock price. So companies try to avoid this if at all possible. But again, according to GAAP, we're talking about the cash flows from the products, for the cash flow from the equipment or property, the long-lived assets. Here we have the Cedar Fair, which was the amusement park, and they're going to record a write-down of $25 million on equipment. This is huge. So what they're going to do is they're not going to take it to depreciation expense. They are going to take it directly to the equipment, reducing the value of the equipment by $25 million and recording a loss on impairment. A loss is like an expense, except it is not something that is ordinarily expected in terms of transactions for the company. It is a part of operations usually, except in this case if this impairment is something that's unexpected or unusual, it might be put in a separate section of the income statement. It'll be recorded as a debit, which is going to reduce stockholders' equity up here, and it'll also be recorded as an expense. Now let's talk about disposals and how we handle disposals. And this is the tangible assets, so property, plant, and equipment. Before we can dispose of these tangible assets, what we need to do is we need to record any depreciation to date. And here's where we have to start counting months, because again, we probably will not remove this asset or get rid of the asset at a exact date at which we expected to be rid of it. We will remove the asset, get rid of the asset when we management feels that it's no longer useful for the company to keep it. It's a financial decision. It's a decision related to the efficiency and effectiveness of using the asset. So it's something that in the beginning we estimated the useful life, but most companies don't discard their assets according to their original plans. They discard according to the ability of this asset to produce, or the effectiveness or efficiency of it. So we may have to update our depreciation. If it's not completely depreciated, we may need to take additional depreciation. And then we record the disposal, and when we record this disposal, we need to remove the asset, and we need to remove the accumulated depreciation account. The reason why it says if any is, recall, with land there's no accumulated depreciation. So with land, you're just going to remove the land account. With equipment, you're going to have to credit the equipment and debit the accumulated depreciation equipment account to remove those balances. So we're going to get cash in usually, and we are going to give up our equipment, and we're going to give up our accumulated depreciation. Now the amount of cash that's going to be the debit to cash is the cash which we receive, whatever that cash happens to be, and the removal of these account balances are determined by whatever's in the account balance. And it's obvious to you probably that sometimes the cash we get in is not going to be equal to the balances in our accounts. So then what we do is record either a gain or we record a loss to make it all balance. And this slide may be a bit confusing to you. When we get into the problems, you'll see what we're talking about. Cedar Fair sold one of its junior roller coasters for $50,000 cash at the end of the 6th year. It originally cost $100,000, was depreciated using the straight line method with zero residual value, and a useful life of 10 years. So the first thing you need to do is determine how much depreciation each year would be taken on this. So $100,000 is the cost. What's residual? Zero. So depreciable cost is $100,000, and useful life is 10 years. So $100,000 times 1 over 10 is, yes, $10,000 per year. Now, what they want us to do, if you can kind of look ahead on this, is they're going to talk about how we're going to handle the disposal. We need to be sure that we take enough of our depreciation and it's up to date. And if our depreciation is up to date, then we would have taken how much depreciation through the 6th year? Yes, $60,000. We have taken $60,000 in depreciation on this asset. So $60,000 accumulated depreciation and a cost of $100,000. What is its book value? $40,000. If the book value of the asset is $40,000 now, and we get $50,000 cash, is this good or is this bad? If book value is $40,000 and the cash we get in is $50,000, remember, book value is what our original estimate was of our salvage value. So our original estimate of salvage value was $40,000 and we got $50,000 in. Is this good? Yes, it's good, and so we record it as a gain. Notice that this is not considered revenue. When we sell off a tangible fixed asset, it is recorded as a gain. It is likewise, it would not, if it had sold for less than $40,000, if we had gotten in $30,000 and we expected to receive $40,000, it would not be recorded as an expense. It would have been a $10,000 loss. So the terminology that you're going to see for these tangible assets, and disposal of them is going to be gain or loss. This is an expected thing that happens within the operations of a company. So unlike impairment, which may be an exception or an unusual type item, gains and losses are natural things that occur in the operations of a business. We do not need to be too concerned if we have a loss one time and a gain another, because our numbers are not going to be precise. We knew that from the very beginning when we started taking depreciation. We do need to be concerned if all the time we record gains or all the time we record losses, because this is an indication that our methods of taking depreciation aren't matching up to what's actually happening in the business. So, selling of this, then, we need to remove the equipment, reduce it. We need to remove accumulated depreciation. Yeah, it is an increase to that asset, but it is a reduction to the accumulated depreciation account. So probably what you need to focus on is removing this credit balance with a debit. Cash is coming in. If cash comes in, always a debit. And the gain on disposal, well, the calculation of this amount, you can handle it several different ways. The way I just spoke of it was to say, our book value was $40,000. That's what we expected to get. And we got more. We got $50,000. This is a good thing. It's a gain. You can also, though, look at the journal entry and put in the numbers. So accumulated depreciation needs to be debited to remove the balance. Equipment needs to be credited to remove the balance. And cash is also a given. If this is a total debit of $110,000, this is a credit of $100,000, we need another $10,000 in credits to make the journal entry work. So when we look at this situation, you can go through it and you can think of it as a plug. What number do I need to make this journal entry equal? So the debits are equal to the credits. You can do it that way, or you can also think of book value as residual value, the expected salvage value of this asset, and compare that to the actual cash received. Either approach is going to get you to the right solution, which is a gain, and the right amount of the gain. Now, intangible assets we just talked about briefly. We said that they didn't have any physical substance, although there may be rights or privileges associated with them, and you maybe have legal documents. You have value with these intangible assets by their rights or what they provide for you. In other words, their physical presence is not where their value is. Their value is in the rights or privileges which they provide for you. And we talked a little bit about trademarks as an example. And we use these typically in operations. It's hard to come up with a useful life. And if you believe you know the useful life, then what you're going to do with these is amortize over the useful life. If they seem to not have any useful life, the analogy I make for it is to compare this to straight line depreciation. In straight line depreciation, you take 1 over the useful life. If the useful life is infinity, you're dividing by infinity, and you can't divide by infinity to get an amount to take to your expense. So there's no amortization, we call it amortization with an intangible asset, if this asset has a useful life that just goes on and on and on. However, in many instances you know the useful life, and the depreciation method is the amortization method is straight line usually, so it's a simple calculation. You record these at their cash equivalent cost, which is everything to get it into a useful condition. So you might have legal fees associated with it or filing fees so that you can actually use this asset. And it's amortized over the limited life, which is the shorter of their economic life or legal lives, using the straight line method. This is a little complicated, the terminology here. So what is it? You amortize it, which is like depreciation, and instead of calling it depreciation, we call it amortization. And if it were depreciation, which method would it be? It would be straight line. So you take a straight line method and you look at it and you say, how long is it useful to me? And you take it over that period of time. Now its legal life could be indefinite, but as I said earlier with trademarks, if you believe that you will no longer use this trademark after a certain point, then you're going to have to say that the economic life is shorter than the legal life. So look at the economic life. How long can you use it within legal bounds? And just use that. A trademark is a symbol, design, or logo associated with a business. They have internally developed have no cost. So if the company develops it internally, they don't pay anything for it. However, if they go out and buy it, they record it at cost. And what you're going to do is amortize this cost over the period which you expect to be benefited from it. So, how long does McDonald's expect to use this trademark? I think a better example would be Coca-Cola. Coca-Cola's trademark keeps changing. And if you'll notice Walmart, at one point Walmart was one word, at one point it was a dash, and at another point there was a star in between Wal and Mart. So these logos change with some businesses. With other businesses, they don't change. If they're internally developed, there's no asset. But if another company purchases a trademark to use the trademark, then it's going to be amortized, and you're going to have to figure out how long you expect to use it. So it's amortized over the period benefited. What is that? It's an estimate, just like depreciation period was an estimate. A patent is a right to sell or manufacture an invention. And you will take this over useful life, or 20 years is a legal life. So how long do you expect to be able to use it, again, is the question to ask. Computer software is another example. Technology assets. So software. Franchises. Now, goodwill is something that is not amortized. It's not amortized at all. And it's when a company acquires another company and they pay more than the fair value of the net assets of another company. That's what goodwill is. And it's not amortized, but you do impairment tests. Oh, so an example here of a patent. Cedar Fair purchased a patent for a water coaster, and it's a particularly new kind of water coaster, $800,000. They expect to use it for 20 years. Now, with these intangible assets also, what you frequently see is there's no residual value. In other words, if this patent has no value at the end of 20 years, there's no residual. You cannot sell it because it is expired. So here we're going to just do straight line. Instead of calling it depreciation expense, you call it amortization, and you end up with $40,000. And so I would say about this, it's not difficult. Everywhere you would see the word depreciation, you call it amortization. There's accumulated amortization, which is another contra asset account, and it goes up by a credit. Okay? And then there's amortization expense, which shows up just like depreciation expense on the income statement in the standard journal entry that's done. So instead of depreciation expense, we call it amortization expense. Instead of accumulated depreciation, we call it accumulated amortization. This is an income statement item. This is a balance sheet item. This is a balance sheet contra. So whenever we show the patent on the balance sheet, we'll say less accumulated amortization. So the patent will also show a book value. So there is a summary here that you might want to read about long-lived assets that summarizes this chapter. If you have limited life assets, you have several methods that you can use for these as far as for tangible assets. For the intangible, everything seems to be done straight line. If there is no life or it's unlimited life, in other words, we don't know when it will actually stop being a benefit to us, we see no end to its benefits, then you cannot amortize it. You just keep it on your books. Whenever you get rid of anything, whether it's a tangible or an intangible asset, remove all the accounts that are on the balance sheet related to this asset. Record what you get in, which is usually cash, although it might be reported as a receivable. You might accept a note where someone's going to pay you the money later on. And the difference when you do the journal entry will either be a gain or a loss. If you need a credit to balance, it's a gain. If you need a debit to balance, it's a loss. Or you can also talk through the situation and say, what is my residual on my books and how much did I receive? Is this good? Is this bad? And you can talk through it that way. Now, another thing which companies sometimes have is depletion. And this happens when we have an oil company, for example, maybe removing oil or petroleum products, and they're going to be selling those products later. And this is a little complicated because what you do is you take the natural resources out of the ground, and then you no longer have this natural resource because the well's value should be going down with the amount of oil that's taken out or petroleum products removed. However, when you take the petroleum products out, then you have inventory that you can sell. So it's a little complicated calculation. That's all I'm going to talk about that topic. Now, sometimes when you're doing your depreciation, you may realize that you could use this asset for a longer period of time than you have. Well, what do you do then? You stop right where you are and you then re-estimate your depreciation and you continue forward with your revisions. So here we have Cedar Fair purchased this $60,000, useful life of 20 years, estimated salvage of $3,000. And so when they start doing their depreciation, you're going to find out that they would be taking depreciation each year. 60,000 minus 3,000, 57 million, and they're going to divide that by 20 years to get the amount they take each year. When they get to the 5th year, though, they decide that it really shouldn't have been 20 years, it should have been 25 years. And if it's 25 years, then the salvage value is probably going to be less than $3 million, which is after 20 years of use, it's probably going to be $2.4 million. It sounds rather complicated, But all you do at this is you go back to you look at your book value when they decide to change it, and you find their book value is 48,600,000, and you take this amount minus the new salvage value over the remaining years that are left from this point, which is at the end of the 4th year.